and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely. So if you look at M2 also, you'll see that it actually peaked in March. Now, this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. And I think I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. And reflecting a little bit more on the Jackson Hole speech, and the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations. And yet, Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point. It's a low base, 13 times. So if they raise the Fed funds rate another 75 basis points, this will be a 16-fold increase compared to Volcker's 2-fold increase. Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one, but most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. But I was in the UK around the time that it had its near Lehman moment. Near Lehman moment means the financial system implosion. And that was just about 10 days ago. And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case for these derivatives. And so the Bank of England had to step in and basically say, well, so we'll see what happens on October 14th. By that time, I think they will have been deleveraged and will be past the maximum pressure associated with this guilt trip, which is why we called this in the new series guilt trip. We're seeing other changes. We've seen China intervene to limit the weakening of the yuan. We've seen Japan doing the same. Now, what is that? What are they doing when they do that? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it does is it sells dollars and buys back yen. Now, that's good in a way. It's doing some of what the Fed should be doing here, actually. It's providing dollar liquidity to the rest of the world. China is doing the same thing. And so we'll see what happens from here. They're not as leveraged as we understand, but one never knows. Well, if not that, what are some of the weak links that we're seeing? We've been worrying about auto credit for a while now, and now we have more reason to. Yesterday, we got the Mannheim Used Car Index. It's a value index, pricing effectively. And it dropped another 3% plus. It was 4% plus decline last month. And so what we have now is it has the year over year increase has gone from 54% in April of 21 to minus 0.1. So there you go, Fed. There's some indication that there's another indication that deflation is in the system. That index peaked in January and is now down 14% just since January. So it's declining at more than a 20% rate. Now, why is this important? We remain astonished at the inventory buildup taking place out there. And the way we're looking at this now from a deflationary point of view, and we think that's the bigger risk now out there, is the pipeline is full of deflationary indicators, starting from commodities, and we'll get into that in a moment. But at the end of the pipeline, downstream at the consumer level, retailers are awash in inventories. And the latest one, pretty provocative, is Nike. And Nike is both a retailer, but it mostly sells to retail. Nike's inventories, well, first of all, its global sales were up 3% in this last quarter. Its inventories increased 44%. And that's an August quarter. There were already telltale signs that the consumer was weakening. Its North American inventories were up 68%.